Good morning. This is Andrew from My Investor's Place. My Investor's Place is a social network website geared towards investors in which we can network, we can discuss ideas of what's happening in the economy, discuss investment ideas. I urge you to join us and contribute. You can post your blog, you can join our forums, ask questions, and have questions answered. The reason I want to talk this morning, I want to talk about the US dollar. And I made a very harsh statement. I said, the US dollar has broken. And what do I mean by that? Does it mean the US dollar has crashed? Let's say God forbid. What I really mean is that there was this money market fund last week called the Reserve Primary Fund, which was holding about $62 billion worth of assets last week. And what happened to them is their net asset value, or which has been the historical norm, $1, fell below parity to 97 cents. This is shocking. This is news breaking. The reason it happened was that in order to enhance returns on their money market fund, they took risks that so many have taken and that are just so, lack of a better word, stupid. They purchased some paper from Lehman Brothers or some of these other banks that were either mortgage-backed securities or student loans or CDOs or CLOs. Let me just tell you real quick, it's actually a disaster situation. And what happened to them last week is they went from $62 billion, where you had just two investors pulled out $40 billion in a day. Traditionally, money funds have been viewed as the safe place. They've been offered by banks, and they've also been offered by independent operators such as Reserve Management. And the point of the matter is, it's like, well, you say, okay, well, if I'm in a bank and I have less than $100,000 per account, I have FDIC insurance. If you've been following my blog, Capital Investor 1836, or the posts that are on My Investor's Place, you can see that I'm questioning really how strong the FDIC is. Last year, the FDIC had about $53 billion in liquidity. And this year alone, one bank called IndyMac out of California, which was heavily invested in the subprime field, took about $10 billion of that out. And then you're having many smaller banks that are failing. There was one on Friday that failed. The FDIC, there's a loss of about 40 some odd million dollars. Well, let me go to the next point. Then there's these independent operators such as Reserve Management. The unsettling thing is, for lack of a better word, they don't even have the protection of the FDIC. So more so in theory that these guys, these independent operators, were even supposed to be more secure and more conservative, and almost like, to be rhetorical, almost like the way the banks used to be. So what I'm also saying is I'm sure that there's many other these money market funds out there that are vulnerable to these blow-ups. And when I say blow-up, that you invested $1 and you're going to get interest on your dollar, well, your dollar became 97 cents. Maybe it'll come 95 cents. Who knows? I'll give you a personal example myself. I invested money into it was a major bank that I've been with for about 25 years, myself and a colleague. We had substantial money with them, and we put it into a cash equivalent fund, similar to this Reserve Primary Fund. And if you, again, to reiterate, my Capital Investor 1836 blog and My Investor's Place, I'm very paranoid, I'm very concerned. And my wife gives me this compliment, obsessive compulsive paranoid, which, thank God, in this case, I really am. Because I asked the bank, and I wanted to know exactly what's in it. And they called back my partner, my colleague, and told him it's 100% safe, short-term government securities, don't worry, it's safe, we're solid. Well, guess what? I called back and I said, I really want to see, what the underlying is. I want to see an absolute breakdown. So I got that breakdown, and I can say I had a nervous breakdown from it. Inside this cash equivalent fund were car loans, real estate loans on golf courses, and yeah, there was a little bit of some government short-term paper, but I mean, it was like so diluted and convoluted, it was really scary. And what I'd suggest to you is, if you're in these cash equivalent funds or money market funds, find out exactly what's in them. Be a little pesky and ask them. I said, I want to see the underlying. I want to see the, all the items that comprise this, because you can get bitten. I mean, you don't want to lose money here, and really, these are crazy, crazy times, and what you have to look for is not the return on money, and so many people are looking to just get a little bit more money, because it's very disappointing to make very little money on our money. But what we have to think about right now is, let's get the return of our money. And again, one of the key points I'd suggest is also make sure that it's in your personal name or your joint personal name with you and your spouse, not the bank's name. And again, I'll reiterate that statement. It's not the return on money right now. We're looking at the return of money. This is Andrew Abraham from My Investors Place. I encourage you to join us. Post your blogs. You can get some exposure once we get up and running. We're just open for a week. Have a handful of members so far. Some interesting conversations, some interesting people, and that's what it's about, is to network, meet people, make some friends, and learn some stuff. So again, My Investors Place, come and join us. Thanks.